The day is January 8th, year 57 AD. Tibulus has etched in stone a promissory note to keep a record of his debt to Gratus of 105 denarii. It's one of the very first examples of a promissory note, the very first type of what we know as a bond. While bonds today are often seen as these non-essential investments relegated to your grandpa's fixed income portfolio, now might just be the best time to start buying them. At its base level, a bond is debt. Some people, companies, and even governments will issue one or many to finance various projects. The recipient gets paid up front and over time pays back that debt, usually with interest. And it was exactly 1,778 years after Tibulus's debt was declared that Andrew Jackson announced for the first and only time that the United States was debt-free. Both the announcement and the dinner celebration took place on January 8th of 1835. But even funnier, the US re-entered debt markets exactly 100 years later in 1935 when it issued the first of its kind, the savings bond. Over the next 150 years, the bond market would evolve and change, eventually growing into the $120 trillion behemoth it is today. That makes it the second largest market in the world, trailing only real estate. Plus, in case you're wondering, the total stock market is valued at 46 trillion, or about a third of this size. So yeah, bonds are kind of a big deal. Today, there are broadly three kinds of bonds: government, which are issued by governments around the world and are usually the safest, municipal bonds, which are issued by local or state governments, and corporate bonds, which are often the riskiest but yield the most and are usually issued by companies. We're going to primarily focus on government bonds in this video because of an interesting quirk unique to them, but let's delve more into the general overview of bonds first. One really good question is, how are bond interest rates determined? To answer this, let's use a scenario. We'll make up a company and call it Meta. Meta wants to invest in cutting-edge technologies, but in order to do so, it needs to raise some money in the form of issuing bonds. By this point, a rating agency has given Meta a credit rating, or the likelihood, based on the company's financial condition, that it will repay its debt. Typically, the higher a credit rating, the more likely investors are to get paid, which means these companies can offer lower interest rates. Contrast this to companies with lower credit ratings. These companies have to offer higher interest rates to entice investors into taking on the risk that they might not get paid. But our fictional company Meta has some really strong cash flows and an outstanding credit rating, AA-, actually almost as good as the US government. Given all this information and the current federal interest rates, Meta issues bonds that will pay out in full in 5 years at a 3.5% interest rate. But looking at Meta's actual bonds, we notice the current interest rate is much higher than when they were issued. As investors lose faith in the company's ability to pay its debts, the price of the bond goes down and the interest rate goes up. Because interest rates and pricing are inversely correlated, the push and pull of supply and demand keep corporate bonds in an extreme state of flux. Yet there's a kind of bond where the interest rates are determined by a higher power. That's right, government bonds. The interest rate for these bonds are determined by the almighty Federal Reserve. And yes, I understand supply-demand economics applies to these markets too, but bear with me for a bit. In general, the Federal Reserve determines the interest rate of bonds as it evaluates economic conditions. As it raises and lowers interest rates, so do the price of government bonds rise and fall. But here's the thing. Over the last year, inflation in the US has run very hot, hitting levels not seen since the 1970s and 80s. It's forced the Federal Reserve to rapidly raise interest rates in an attempt to slow down the US economy. In fact, the rate in which the Federal Reserve has raised interest rates has been the fastest in US history, and this move has had an effect on inflation, causing month-over-month inflation to fall from its highs of over 9% to 7.7% in the most recent report. While it may not seem like a steep drop, the Federal Reserve had to approach inflation very cautiously, because raising rates any faster could very easily force the economy into a deep, dark depression, especially given the looseness of monetary policy over the last 3 years. But many have begun to speculate, including the largest financial institution in the world, that the Fed could be considering a pivot on rates, beginning to cut them down as to not inflict too much damage. But it's not a question of if the Federal Reserve will begin to cut rates, but a matter of when. Multiple members of the Fed have also come forward saying they expect to cut rates and start cutting soon. inflation. On the flip side, raising rates has actually caused the value of government bonds to fall dramatically, some up to even 30%. When this pivot comes and rates start falling again, the price of these bonds will start rising. And the best part is, if you hold these bonds, you can just sit around and collect the abnormally high interest rate while waiting for the pivot. If rates don't get cut for 6 more months, that's 6 more months of collecting potentially high single-digit interest rate payments. The biggest question is, how do we actually get exposure to these bonds? If you go to basically any brokerage, you get transported back to 1998 and face a tough time navigating this seemingly left-behind world. But that is where the magic of ETFs come in. These wonderful financial products allow us to gain exposure to a wide variety of bonds while letting someone else manage the renewals for a small fee. But another question pops up, which ones do we even bother looking at? Ideally, the answer is in government bonds with the highest interest rate risk, or longer-term bonds. Because interest rates have a greater potential to rise over time, long-term bonds are usually more volatile than shorter-term ones. This idea actually plays out when you look at the various bond ETFs on the market. Glancing at the Vanguard short-term bond ETF BSV, we find it's only fallen about 8% this year, meaning if the Fed fully cuts rates this year, you can reasonably expect an 8% return. However, if you're looking at a longer-term bond ETF like TLT, which holds bonds expiring in 20 or more years, it's fallen an incredible 30% this year alone. If there's a pivot, more volatility will rock this space, meaning there's a higher chance of returns. But there's yet another option to consider. If you don't want to take the chance of betting exclusively on government bonds, you can get a more mixed ETF. And BND fits this profile quite well. It holds pretty much every bond on the market. Though BND mostly holds government bonds, there's a greater variety that includes both corporate and municipal bonds. While it lowers the exposure to treasuries, it would also provide more stability and a steady stream of income through the ETF's monthly payments. And this brings me to the broader point. I believe every investor should have a few bonds in their portfolio in some capacity. For older investors, it means a steady stream of income that is some of the safest on the market. For younger investors, it could help hedge a portfolio against market crashes, smaller drawdowns, or even an unexpected dip in core portfolio holdings. Advantages like this seem rather nice, so you might be wondering, why doesn't everyone own bonds? Well, unfortunately, bonds just don't have the higher returns like stocks over longer periods of time. Because of their fixed nature, the returns are very limited. Once a price is determined with an interest rate, it limits those levels of return, despite fluctuation. In some cases, bonds can fluctuate a lot, but they'll still only yield a fixed return regardless. On top of that, the shorter the term of a bond, the less price and interest rate tend to move. That's why you see such large discrepancies between bonds like long-term bond ETF TLT, which holds those 20-year plus government bonds, and the ultra-short-term ETF BSV, which holds those short-term treasuries. All in all, there are plenty of reasons for the average investor to own bonds in their portfolios. That said, I don't own any, mainly because I sold all my bonds I held in the middle of this year. 1, I wanted to enter new positions in other companies, and 2, I wanted to bolster the existing positions in my portfolio. But I'm now seriously considering re-entering the bond market. I believe its value proposition is finally good again. If you want to interact more with my thoughts and follow my journey back into bonds, you can join me on Common Stock, where you can watch my entire portfolio moving daily. Link in the description. That said, that's all I've got for you in this video. If you enjoyed it, I imagine you'll enjoy the video on screen now. I would love to hear your thoughts on bonds in the comments section below, and let me know which ones you have or are considering buying. As always, this is Dollars and Cents, helping you make sense of making dollars.